On Wall Street, there are two kinds of investors. The first type, smart, fast, always reading the latest news and jumping into every hot stock they can find. The second type rarely talks about money. He simply invests a fixed amount in an index fund every month and forgets about it. 20 years later, something surprising happens. The second guy ends up wealthier, not because he knew more, but because he knew less and did it better. John Bogle, the founder of Vanguard, once said, "Investing is not a game of intelligence, it's a test of character." And millions of people who follow his philosophy, known as Bogleheads, have proven one thing: you don't have to beat the market. You just have to make sure the market doesn't beat you. And in today's video, we'll explore 7 simple, effective, and timeless investing principles from the Bogleheads Guide to Investing. Principles that can help you sleep better, invest smarter, and most importantly, live freer. If you've ever felt that investing is too complicated or that you're not smart enough to become wealthy, this video might change that belief forever. Part 1. The Bogleheads Philosophy. Wealth doesn't require intelligence, just consistency. There's a paradox in the world of finance. The smartest people often make the worst investors. Not because they lack knowledge, but because they think they know too much. John Bogle, the father of the index fund, once said he had met countless people with MBAs working on Wall Street, able to read a balance sheet like it's the morning paper. But when the market turned red, they panicked. And when stocks surged, they rushed in like moths to a flame. Meanwhile, ordinary people, teachers, engineers, nurses, who never read financial news every morning, just quietly invested in index funds month after month, patiently waiting through the ups and downs, ended up becoming the truly wealthy ones. The Bogleheads philosophy was born from that kind of humility. They believe no one can predict the future of the market, so the best strategy is simply not to try. Instead of chasing hot stocks, they choose to own the entire market through index funds. Instead of trying to beat others, they focus on not beating themselves by avoiding mistakes, keeping costs low, and staying invested for the long run. What makes this philosophy powerful is not its complexity, but its elegant simplicity. True wealth doesn't come from being smarter than others, but from staying consistent with your principles when everyone else loses faith. As the great investor Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." The Bogleheads are living proof of that. They're not trying to win every battle. They're focused on winning the only war that truly matters, the war against their own emotions and impulses.
Part 2. Living below your means, the root of all wealth. If you ask any successful investor, what's the biggest secret to building wealth? They won't talk about technical analysis or about finding the next stock that goes up tenfold. They'll tell you something that sounds almost too simple. Spend less than you earn and invest the rest. It sounds easy, but in reality, it's one of life's greatest challenges. In America, one of the wealthiest nations on earth, most people still live paycheck to paycheck, even though incomes are higher than ever before. Not because they're lazy, but because they're caught in a race with no finish line. The upgrade life race. Upgrade the house, upgrade the car, upgrade the phone. Meanwhile, the savings account stays exactly the same. John Bogle once said, "You can't buy freedom with things you don't need." It sounds like moral advice, but it's actually a financial strategy. Because if you want to invest, you first need money to invest. Take the story of Sarah, a high school teacher from Ohio. She doesn't make much, about $55,000 a year. But she follows one simple rule. Live on 70% of her income, save 10%, and invest 20% in index funds. For 25 years, she didn't buy a new car, didn't rack up credit card debt, just kept investing, month after month. By age 55, Sarah had over $1.1 million in her investment account. And something even more valuable, she never worried about money. Meanwhile, there are people earning $200,000 a year who still feel suffocated by credit card debt. Because every time their income goes up, their lifestyle expands with it. Bigger houses, newer cars, and well-deserved luxury vacations. That's not financial freedom. That's financial slavery, wrapped in glamour. Bogleheads understand this deeply. They don't live in extreme frugality, they simply spend intentionally. They know the difference between wants and needs, and they understand that every dollar not spent today is a brick laid for tomorrow's freedom. As Bogleheads like to say, your true wealth isn't measured by the things you own, but how long you can live without needing a paycheck. Living below your means isn't about deprivation. It's about selective living, choosing what truly adds value and cutting out what doesn't. Just like pruning a tree helps it grow taller, cutting unnecessary expenses allows your wealth to grow stronger over time. Part 3. The power of compound interest. Time is your most valuable asset. Albert Einstein once said, "Compound interest is the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it." That quote sounds simple, but behind it lies the key to all lasting wealth. In the world of the Bogleheads, no one tries to predict the market. No one tries to beat Wall Street. All they need is time and consistency. Because when you invest early, time starts to work its quiet magic, turning small numbers into big ones and discipline into freedom. Imagine two friends the same age, Tom and David. Tom starts investing $5,000 a year at age 25 and stops after just 10 years, a total of $50,000. David decides to wait until he's ready. He starts at 35 and invests $5,000 every year until he's 65, a total of $150,000. When both retire at 65, who has more money? Not David, even though he invested 3 times as much. It's Tom, because time worked for Tom, turning his first 10 years into 40 years of compounding growth. Tom ends up with nearly $950,000, while David finishes with just over $800,000, despite investing $100,000 more. That's the silent power of compound interest. It rewards those who start early and punishes those who wait. Many Americans still believe they need a lot of money to invest, but Bogleheads think differently. They know it's not about how much you have, it's about when you start. A small investment today is far more powerful than a big investment 10 years from now. Warren Buffett is living proof of that. He began investing at age 11, and over 90% of his wealth came after he turned 65. Not because he was smarter, but because he was more patient. He understood that the stock market is a device for transferring money from the impatient to the patient. In the Bogleheads Guide to Investing, Taylor Larimore reminds us, "Let time be your ally, and the market will do the rest." No complicated strategy, no market timing, just a simple index fund, regular contributions, and the patience to let compounding work uninterrupted. Remember, time doesn't just grow your money, it protects you from mistakes. As the years pass, short-term noise fades away, and what remains is growth in the economy, in your portfolio, and in yourself. Because investing isn't about getting rich fast. It's about letting your money work long enough so that you don't have to work forever.
Part 4. Investing Made Simple. The Power of Index Funds. If there's one idea that defines the entire Bogleheads philosophy, it's this: investing doesn't have to be complicated to be effective. For decades, the financial industry has tried to make investing look like rocket science. They throw around fancy terms: alpha, beta, arbitrage, momentum. They convince you that only the experts, armed with supercomputers and PhDs, can beat the market. Then came John C. Bogle, the founder of Vanguard, who said something that shook Wall Street to its core. Don't try to beat the market, just own it. He created the world's first index fund, an idea mocked at the time as a fund for idiots. But Bogle didn't care. He understood that instead of trying to pick the winners, owning the entire market was a far more reliable way to win. Why? Because most professional investors, hedge funds, mutual funds, and analysts alike, underperform the market over time. Not because they're bad at their jobs, but because fees and taxes slowly eat away their returns. An index fund, on the other hand, doesn't try to outsmart the market. It simply tracks it with ultra-low costs, no emotion, and total automation. That means you don't need to guess which stock will rise next. You don't need to worry about breaking news or CNBC hot tips. You just invest regularly and let time do the work. Here's the math. According to S&P Dow Jones indexes, over 90% of actively managed funds in the US underperform the S&P 500 over 15 years. Meanwhile, an ordinary investor who simply bought an S&P 500 index fund, sat still, and did nothing, outperformed almost the entire Wall Street machine. Bogleheads call this the art of simplicity. They understand that every time you try to outsmart the market, you're stepping into a game you cannot win. But every time you keep things simple, invest in low-cost index funds, contribute regularly, rebalance once a year, you're playing a game you can't lose. Think about it. If you invest $1,000 a month in an S&P 500 index fund, earning an average of 8% a year, you'd have nearly $1.5 million after 30 years. No stock picking, no timing the market, just consistency. That's what made John Bogle the quiet hero of millions of American investors. He never promised you'd get rich quickly. He simply showed you how to get rich surely. As Bogle himself once said, the market may fluctuate, but low costs and long-term discipline never betray you. Bogleheads believe that financial freedom doesn't come from knowing more, but from wanting less. Less noise, less worry, less ego about being smarter than the market. Because in the end, simplicity always wins in a complex world. Part 5. Diversification. Don't put all your eggs in one basket. One morning in 2008, America woke up in panic. The biggest banks were collapsing like dominoes. Lehman Brothers went bankrupt, AIG needed a bailout, and within weeks, millions of people lost their life savings. But here's the thing. Many of them didn't lose because they invested wrong. They lost because they put everything in one basket. One person poured all their money into their company's stock, believing, "I know this business better than anyone." Another went all in on real estate, thinking land never loses value. Someone else bet everything on crypto because this is the future. Then a single unexpected storm hit and everything vanished. That's why Bogleheads don't see diversification as a tip, they see it as a survival rule. John C. Bogle once said, "Don't seek perfection in every investment, seek safety in the whole portfolio." So, what does diversification really mean? It's not just about spreading money around, it's about spreading risk. A smart Boglehead-style portfolio might include stocks, index funds for long-term growth, bonds, bond funds for stability, cash or money market funds for flexibility when needed. The exact mix depends on your age, goals, and risk tolerance, but the core idea stays the same. Never let one bad event cost you your peace of mind. Here's a very American example. During the 2020 COVID crash, the US stock market fell over 30% in just a few weeks. But investors who held a mix of S&P 500 plus government bonds plus cash funds only saw losses around 10 to 12%, and most recovered within months. Meanwhile, those who went all in on tech stocks lost 50 to 70% of their portfolios and spent years trying to recover. Bogleheads believe diversification is free, but the lack of it can cost you a lifetime. Because no one knows which sector will win in the next 5 years, tech, energy, or bonds. But one thing's for sure, if you spread your bets wisely, you'll never lose big. And that's something more Americans are learning today. Diversification won't make you rich overnight, but it will make sure you never go back to zero. You don't have to be right all the time. You just have to avoid being completely wrong even once. Because in the end, the goal of investing isn't to be a genius, it's to be the one who stays in the game the longest. Part 6. Don't try to time the market. If there's one illusion that has cost Americans more money than anything else, it's the belief that they can predict the future. When the market goes up, everyone thinks they're a genius. When it goes down, everyone says, "I'll just wait a little longer." But that little longer often turns into months or years, and the real opportunity is already gone. John Bogle, the founder of Vanguard, once said, "No one knows when to get in or out of the market. And if someone says they do, they're lying." That's not pessimism. It's humility from a man who spent his entire life watching markets and realized that no one can outsmart randomness. Think back to 2020 when COVID-19 hit. The US market dropped more than 30% in just a few weeks. People panicked and sold, believing this time everything will collapse. But just 6 months later, the S&P 500 hit new all-time highs, and those who simply stayed put were the ones who won. Meanwhile, millions of investors tried to jump in and out, buying on good news, selling on fear, and ended up doing worse than those who did nothing at all. A Morningstar study showed this clearly. Over the past 20 years, the US market returned about 8% per year, but the average individual investor earned only around 4%. Why? Because they timed the market and got it wrong. Bogleheads don't try to predict the future. They just stay patient, automated, and disciplined. They know the market is like the tide. It rises and falls, but you only drown if you panic and swim against it. Here's a familiar example from many Americans. During the dot-com crash of 2000, those who held on to their S&P 500 index fund for the next decade still earned roughly 6 to 7% per year. But those who got out to wait for a better time usually bought back in after the recovery, missing the strongest part of the rebound. John Bogle called this the tyranny of timing. You get obsessed with doing something right now when the smartest move is often doing nothing at all. As Bogle said, stay the course. Stay on your path, no matter what the market does. That's why Bogleheads don't treat investing like a game. They see it as a lifelong journey. You don't need to win every quarter or every year. You just need to let time do its work. Because in the end, consistency beats intelligence, and calm beats urgency. Remember this, The market will always move up and down. But if you have a plan, discipline, and faith in time, you'll never need to predict anything at all. Part 7. Psychology and discipline. Your biggest enemy is yourself. In investing, intelligence is common, but patience is rare. If you've ever opened your stock app in the morning, felt your heart race when the numbers were green, and sunk when they turned red a few hours later, you've experienced what every investor, no matter how smart, goes through: emotional investing. John Bogle, the father of index funds, saw millions of Americans lose money not because they made bad investments, but because they couldn't handle fear. When the market drops 10%, they think, "I need to get out now." When it rises 20%, they think, "I'm missing out." And so they keep buying high and selling low, again and again. A Dalbar study found that over 30 years, the average investor earned only 3 to 4% per year, while the S&P 500 returned over 10%, not because investors picked the wrong stocks, but because they couldn't control themselves. Bogleheads know this well. They don't let emotions steer the ship. They let principles do it. They have a plan, and they stick to it, even when the market tests their patience. Think of it like climbing a mountain. When the fog rolls in and you can't see the summit, the impatient turn back. The disciplined keep walking. Investing is the same. The market doesn't reward the fastest reactors, it rewards the calmest believers. Here's a familiar American example. During the 2008 financial crisis, millions cashed out their 401ks in panic. But those who kept contributing monthly and held steady in low-cost index funds, by 2018, their portfolios had doubled or even tripled in value. Not because they were smarter, but because they had better self-control. Bogleheads don't try to beat the market. They try to beat themselves every single day. They know investing isn't a test of IQ, it's a test of EQ, emotional intelligence. As Taylor Larimore, co-author of the Bogleheads Guide to Investing, said, "Keep a cool head and a warm heart, because in the end, the market is nothing more than a mirror reflecting human emotion. If you can stay calm through the storm, you're already ahead of 90% of investors out there." Financial freedom isn't a dream reserved for the special few. It's the result of small habits repeated consistently over time. Spending less than you earn, investing regularly, and trusting in the quiet power of compound interest. You don't need an IQ of 150. You don't need to predict the market. You just need a simple plan and the discipline to stick to it, no matter how chaotic the world becomes. That's the spirit of the Bogleheads, where patience beats speed and simplicity outsmarts complexity. If you want to begin that journey today, read The Bogleheads Guide to Investing. I've left the link below this video. Because this isn't just a book about investing. It's a guide to building a life of freedom, peace, and enough. Start today, because financial freedom isn't a dream. It's a habit.